All right, what's going on, everyone? This is episode 3 of Equanimity. Super excited for another video. And, looking back at last video, what we discovered is how to find new and interesting but high quality businesses, and then ultimately, hopefully, buying them at a reasonable price. So, building on that, what this video is going to be about is actually diving into the research and what it takes to really understand these businesses. I'll be walking you through each of them. And then I will also, at the end of the video, share our top 10 stocks as of right now. So make sure you stick around to the end to really see what those top 10 are. Things have changed a little bit. So definitely something to keep and look forward to by the end of this. But with that, I want to kind of cover what we looked at and provide a brief summary of the companies we found. And then we will progress on to the actual deep dive of the research. So we found 3 companies looking at or using a stock screener. At the time, it was Macro Trends. And I actually want to provide one additional stock screener that I think may even surpass Macro Trends. And I've used it before in the past, but it's at finviz.com. So if you just go to their screener tab, you can see that they have a wide array of filters at the top here. So there's descriptive, fundamental, technical, news, ETF, all. Honestly, I would ignore descriptive, technical, news, ETF, and all, and really just focus on the fundamental element of it. I think, again, I'm a huge proponent of investing based on quality, and quality is a direct reflection of the business's fundamentals. So in here, you don't necessarily want to overpay for companies, so you could cap the price to earnings at 30. It's going to give a little load. Couple other things you want to look at, maybe operating margin. Let's say we could get it higher. You want good, solid, healthy margin and retaining a lot of profit. So over 20 here. I always talk about, return on invested capital and debt to equity here. Perhaps we'll put this at under 1. So anytime they could essentially pay off all their debt within a single year. And then I'm trying to find it here, but I am having difficulty. There it is. Return on invested capital. So that is something that Macro Trends does not have whatsoever. And as we talked about, you always want that over 10%. So just a quick demonstration of another screener here. You're going to have a nice list of companies. They have over 4 pages of businesses that you can explore. And really what it comes down to is just search for companies. A lot of investing is merely about your desire and your characteristic of being curious. And so if you want to go and learn about the world and learn about business and what it takes to build a good company, that's what this all is about. So anything like this, a screener, is ultimately for discovery. You're going to find businesses. You can see here, like Arista Networks is one that I've definitely tracked, ASML, Broadcom, Brookfield Asset Management, AstraZeneca's here. So a lot of good companies already. You can start just with using this platform, but feel free to mess around with it, do your own thing. Find companies that work for you, but all it comes down to at the end of the day is quality and price. Okay, so with that, in the last video, we found 3 companies, 3 very different businesses, and businesses that are at different stages in their business cycle overall, or their lifetime, let's say. And one is an e-commerce, one is a ride-sharing platform, and one is an insurance company. So that would be PDD Holdings, the owners of Temu, Shop Like a Billionaire. We got Uber Technologies, of course, everybody knows it, everybody uses it. Sometimes we don't like the prices we have to pay while we're using it, but it is inevitable. And then lastly is Travelers Insurance. So it was a company, we found a couple insurance companies last time. We were looking at Allstate as well. And ultimately, Travelers demonstrated the greatest consistency within their financials. And so we decided to dive a little deeper. And you never know, some of those companies that often get slept on can be gold mines, really. Diamonds in the rough is another way to say it. So what did I do following the video? Well, I actually built up a financial breakdown of each of these businesses. And we are going to look at each of them and do a quick review of their financial progress or where they're at today, and then progress a little deeper into the weeds as to what it means to discover investing and really figure out what it takes to build a quality company. So again, I want to reiterate, I love to capture ideally at least 10 years of historical financial data, because when you look at a short window, this could be 3 years, even 5 years, a lot can happen that may not be reflective of the true economics of the business or the macroeconomic environment of the world, the country, wherever it operates in. And so the longer you can zoom out and really look into history, that's where you're going to see the consistency. Sometimes companies catch a lucky break and they benefit from a wave, a trend. That can be AI companies today. Maybe they're making a lot more money than they rightfully deserve at this time. But that's just a prime example there. But ultimately, 10 years, that's the goal. If not, you're going to try and get as close as you can. In this case, Pinduoduo had from 2017 to 2024 in terms of full year financial statements. So that's what I captured here. And what you can see is, again, what we talked about is that they are on a crazy growth trend right now. From an overall standpoint, they are growing annually at about 64% per year, which is absolutely absurd. I would say the average is around 15% for solid companies. So 64 is ridiculous. Can they keep it up? Maybe. Who knows? That's your judgment of their platform as well as the companies they own, like Temu. Do they have those economic characteristics that will sustain that type of growth? But again, even if it was slashed in half, grew at 30%, that's still well above average. So something to consider there. But you can see it across the board when it comes to their financials. So revenue in 2017, $278 million. In 2020, $9 billion. And as of 2024, $54 billion in sales. So that is a massive jump. They are doubling their money pretty much every single year. And you can see that on a 7-year basis here up at the top, that they're growing right now on an annual basis over that 7-year period by 112% annually. So very, very impressive from a revenue standpoint. But as I said in the previous video, is that revenue is not everything. You can grow revenue really fast. You can make a bunch of sales, but if your costs are accelerating faster than your revenue growth and your profits can't keep up, then it's all for naught, because ultimately you end up losing more money than you would retain. So what you want to see is, while revenue is growing, that so is your profit margin reflecting that growth and being sustained or growing too. If not, you got to ask cause for concern. Are they spending too much? Are they investing too much and doing it too recklessly, trying to get ahead of the curve without ensuring the long-term sustainability of the business? Now, the other element of profit margin is, of course, profit. So another way to say that is net income. In 2017, they were actually losing money, about 84 million. That would actually drop to 1.5 billion in 2018, but they turned it around in a couple of years, and in 2021 they reached their first year of profitability at $1.2 billion. And since then, as of 2024, they are now at $15 billion in profit. So phenomenal growth. And again, you can see it here in their profit margin. They were losing money, negative profit margin throughout, and then they turned the tide, and now they are averaging at least about a 24% profit margin over the past 3 years. And over a 5-year period, you're seeing about 15%. So excellent position. They really improved their sustainability overall. These are all positive signs looking at it from the get-go. Another element, as we always talk about, is book value. And this is essentially what assets would remain if you had to pay off all your debtors and liabilities in the form of bankruptcy. And if you can still retain assets after all of that, then you still have value at hand. And that is what book value or shareholder equity is. So once again, 2017, it was negative at 160 million. Then they quickly turned it around the next year they were already at $2.7 billion of book value. 2021, this has grown to $12 billion, and as of 2024, they are at $43 billion of book value. So all things trending in the right direction, and you can see it here. One thing to note is wherever you see not available, that's because there is a negative in the denominator, and it can't actually be effectively calculated. So I tend to omit those. I still retain the same weightings based on a yearly basis. So 3 years has lower weighting than a 7-year here. You can see that by the value of 0.1 versus 0.6. So it tends to normalize it out and average it and just make sure it's still conservative, even though you're seeing, say, net income here is at 133% in a 3-year span. Again, the shorter the period, the less predictable it is. From there, the last one that we really look at, well, actually, I do want to highlight one more thing. The other thing is they have no long-term debt. So that is the ideal situation for any business because, again, Debtors are going to come chasing after you. They want their interest payments and they want their principal eventually. And if you continually have to do that, or you reach a tough situation where maybe you're losing money for a year, you still have to pay, and you got to find a way to have that cash available. And if you don't have it, that's when they come and knock in. That's when you go bankruptcy, and that's when the stock goes to zero. So if a company has zero debt, that is the ideal situation, and Pinduoduo has that. So from there, the last one, and arguably the most important financial metric that a company can ultimately possess, is free cash flow here. So you're going to see that at the bottom. In 2017, they were already free cash flow positive. That's a good sign from the get-go. Like, you can't complain about that. 49 million, 2017. This has quickly expanded since then. 2021, they were at 4 billion. And as of 2024, they were at $16.5 billion of free cash flow. Phenomenal. Again, this is ultimately free cash flow. If you need a quick refresher, is that it is the cash after everything is paid for in a year or in a quarter, really. What cash does the company have to retain? That's after taxes, interest, the operating expenses, investments, all that. So this is what the best sign, because it really shows you're bringing in money. It's like your income at your household, and building up those savings and contributing to that. And then as a business, ultimately they reinvest it, which is what allows them to grow. And so should you with your money. I'm not saying how, but definitely consider investing, because that is the power, and that is what you can see reflected in companies here. So from a growth standpoint, everything is trending in the right direction. From a long-term standpoint, free cash flow really is growing at 130% annually over a 7-year period. Even at the 5-year mark, 65% for revenue, 65% for book value, and 51% for free cash flow. Phenomenal. Okay, and then lastly, the 3-year, we got 54%, 133% for net income, 54% for book value, and 61% for free cash flow. So really, from this standpoint, there are not many companies out there. I'm telling you, I have looked at thousands of businesses, and from a financial standpoint, Pinduoduo is at the top already. I can tell you that. The biggest thing that you are going to need to consider is, do you want to invest in another country? And, how confident are you that you really know this business if you are not a customer? That said, Temu has definitely penetrated the North American market, so something to consider there. Then on a 5-year average basis, you can see ROIC. Again, super important metric. This is the one that I prize above all else, because it is a reflection of management's ability to generate high investment returns, and it is the best indicator of long-term performance. Right now, they are averaging over a 5-year period 19%. Debt to free cash flow, again, 0%, no debt whatsoever, best situation you can be in. Profit margin, 15% over a 5-year average. Free cash flow yield at 11%, so that's pretty solid. That ultimately kind of indicates that if you bought today, you could expect about 11% return at today's prices. That is never a super accurate indication. Things are always changing, but that's another good idea right there. And then lastly, of course, the growth rate there at 64%. So phenomenal business. That said, I do want to tell you what their valuation is at this point. It is one thing if the company is very high quality, but is it trading at an attractive price? Well, let's look over to this section here, and a reminder of how you calculate the value of a business is, first, you're going to project the company's free cash flows out into the future. So what I do is pull a 3-year average of the past 3 years of free cash flow that the company's produced and grow it at the typical growth rate. Now, 64% again is phenomenal, but it is hard to imagine that they will be able to sustain this over the long run. The bigger you grow, the more difficult it is to grow at these faster rates. And so what I like to do is, anytime I see a business that is growing above 25%, is I actually cap their growth at 25%. It's just to provide a more conservative assessment so that you don't run into danger where you're expecting that, Pinduoduo is going to grow their free cash at 64% forever, and that's not the case, and then you've overvalued the business, overpaid for it, and you get burned. So this is a good way to be conservative. I project those 5 years out, 25%, so that is what you are seeing here. And then into perpetuity, because you are ultimately assessing free cash flow forever, essentially, what I do is slash that in half, because you want to be even more conservative. Can they grow at 25% beyond the next 5 years? Maybe, but it's better to be conservative and set your expectations at a realistic point so that you don't put yourself in danger and don't make poor investment decisions. That is this number here. So it is essentially saying that as of this point into perpetuity, that they would be worth about 1.5 trillion from this standpoint. Now, money is not all equal or created equal. The further out you go, the less buying power you have. That is the wonders of inflation. And so what you do that is you discount that back at a certain discount rate. Again, I want to be super conservative, so I use a 15% discount rate. That essentially means that bringing it back times the number of years, it is going to make the amount of free cash flow relative to today's dollar, the worth of today's dollars, is a lot smaller. And that's what you're seeing below here as a reflection, at least on a 5-year period, is the further out you go, even though it looks really good, $37 billion in free cash flow, realistically at today's, it's more closer to 19 billion. So that sets your expectation, protects you from making difficult or poor decisions and not assessing, all the factors that play into it. So from there, we get the sum of all these discounted cash flows, and that produces our net present value here. And the last piece is to strip out any debt from that valuation and add any marketable securities and cash that the company has. So that would be anything that is directly liquid and they could deploy in an instant or in the short term if they needed to. And so adding those all together, we get the value of the business here. And currently it is showing at an $891 billion valuation, which is pretty phenomenal given the fact that today's market cap is at $158 billion. So that is essentially implying that the company is undervalued. Now, a couple caveats and things you want to keep in mind is, again, the faster the growth rate, the more that you're going to see these free cash flows expand at a faster clip. That's not a bad thing, but you always want to be a bit skeptical and cautious whenever a company is growing super fast, because it's just difficult to know how long they'll be able to sustain it and what is their long-term average. So we try to mitigate that to some extent here, but ultimately, and from that, we're seeing that the company is undervalued. One way or another, it is well below 50% of what we think the company is worth. And so that is a good margin of safety to start with. And then from there, you're going to want to do the next steps of diving in. But with that, we will move on to the next financial elements of our next company, which is Uber Technologies. So everybody knows Uber is the largest rideshare platform, at least in the Western Hemisphere. It has definitely improved, and that was something that I learned in last video, is that they have reached a point of profitability. You are going to see that here, and let's dive into this thing. So once again, it does not have 10 years of financial data. It does have from 2017 to 2024, and so it still gives us a good glimpse of where they are at, especially over the past 8 years, but ultimately, if you can get 10 years, that is ideal. So first, starting with revenue. In 2017, they were generating about $8 billion in revenue. This grew to $11 billion in 2020, and as of 2024, they are at $44 billion. So check that off to our list. That is solid growth overall, and that is reflected up here as well. So you can see that over a 7-year period, they have grown their revenue by about 28% annually. Definitely a good sign. Strong growth. Anything above 15% is a good sign and indication. I mean, really, anything above 10% is solid, but we want to set the bar higher. And so if we can see that, that is impressive. Now, net income's a bit of a different story, but it has definitely improved, and we like to see it. So, 2017, they had $4 billion loss. They actually became profitable in 2018 with about $1 billion in profit. This then went back to the negative, and for 3-4 years, and really, especially in 2022, they lost about $9 billion here. But things have turned around over the past couple of years. $2 billion in 2023 and $10 billion as of 2024. So they've turned it around. Ideally, the point is to reach a point of profitability. They have done so. So they are definitely a lot more sustainable than they once were. You can have more confidence in their fundamentals, and that is being reflected as well. You're seeing it here. again, wavering and very negative profit margin for the most part. And then in the past 2 years, they've really turned it around, especially in 2024. This is the first time that they've really demonstrated themselves to be a profitable and favorably economic business, or economically favorable business. So we are seeing that again, though, on a 5-year average basis. It's still negative at 13%. So that's just one thing that, again, looking at Uber today, solid business, but I would want to see that they have demonstrated that consistency over a longer period. Is this going to just be another 2018 to 2019 episode, or can they actually maintain that profitability into the future? Those are the questions you want to ask. And so when looking at Uber, they're definitely on the right trend, but it's still always good to be skeptical and guard yourself based on the realities of today and not what could be in the future. So still good position, and we're going to see that further here. Again, book value negative $8.5 billion in 2017. 2021, they grew that to $15 billion positive. And then as of 2024, they are now at $22 billion of book value. So very good sign. They've definitely improved that over the past couple of years. And you're seeing that growth. Again, a lot of negatives in here. And so, especially in the early days. And so that's why these are taken out. But on a 5-year basis, they're growing book value at 8.5%. 3-year basis, 14%. So solid growth overall. Something to be pleased about in general. And they are turning on the right direction. They do have debt, and you can see that this has expanded, but they are tending to pay it off over the most recent years. And if we look at their debt to free cash flow as of right now, it's 121%. So that means that they could essentially pay it off with their free cash flow in just over 1 year. Still a good sign. They are not in deep trouble when it comes to debt, but compared to Pinduoduo, you're seeing zero debt whatsoever. Again, ask yourself, what is the higher quality business at this time? You can definitely, that's one indication right there. The last one, free cash flow, again, similar, mimicking net profit for the most part, negative for the early years. Then they turned it around in 2022, first year of free cash flow positivity. So that is $400 million there. And since then, it has grown as of 2024 to $7 billion. So definitely turn it around. 2024 really seems like their hallmark year, the year that they've set the tone. And now it's just a question of, can they sustain that? So, as their 10K comes out for their 2025 annual financial data, we will add that to the measure here and see if that stands, if they are remaining consistent, and we will see these growth rates tend to change from that. But based on the weighting of everything, based on the measures and protections that I've built in place, it only shows right now that they're growing at about 3%. So not ideal, definitely a tough position in general. And that growth rate is, could be a lot higher. It definitely shows in these more recent years that they are growing at a higher clip, but just set realistic expectations. I like to be conservative and make sure that everything is considered and that you're not overlooking or overhyping a business. So that is exactly what I am doing here. Last one to look at is return on invested capital is for a 5-year basis is negative 9%. So not ideal again, but this should improve if they can sustain profitability in the years out. So right now they only, in the past 5-year period, have had 2 years of profitability. That's why you're seeing negatives here at this time. So increase profitability, you'll get better metrics, and then you'll go higher up on my list. With that, we'll look at their valuation and project those cash flows into the future, discount them back, get the net present value. We're going to take away the debt, and then we're going to add in their cash and marketable securities, and that gives us a business valuation of $29 billion. So compared to their market cap of $164 billion, this is the opposite story of what we're seeing in Pinduoduo. This company is significantly overvalued based on this assessment. And now you could say, well, Declan, your assessment isn't very realistic because, again, you're giving them such a low growth rate. Their free cash flow isn't reflective of what they got in the past year. And both of those are true. I could be wrong on the valuation. Any of these are going to be potentially wrong, and you're never going to get any one of them exactly right. The idea is to get as close to certainty as possible. And right now, and what I believe in my process that helps improve my level of success is the fact that I am very conservative in my valuations. This protects me and guards me from any dangers. again, they sure could keep growing, and I could be wrong. Maybe they grow to $500 billion in valuation. And you could look back and be like, wow, I more than doubled my money. It's all possible. But based on the financial numbers at this time, what is tangible, what has been demonstrated by the business, I think they are worth a lot less. And this is, by looking at this and being able to compare this, I am able to protect myself from making an ill-advised investment. So something definitely to consider on your end too, and why I factor in valuation so much, because, Uber is a very interesting business, definitely a product that I use. I am a customer of it. I use it often, but it has not reached a point where I am confident as an investor that it is going to generate me a solid return. And for now, something that I would pass on at this time. But with that, we do have one final company, and that is the Travelers Company. So Travelers Insurance. And, this is an interesting one. I talked about it last time, but, you're going to find a lot of fascinating, high-tech, fast-growing companies that the news talks about, everybody's raving about. But sometimes it is these kind of quieter businesses that stand out and make you consider, oh, maybe there's a potential investment opportunity in a business that I may have never thought of before. And I think Travelers is a good example of that, because one, they have definitely been around a lot longer than PDD as well as Uber. You can see that they have at least from 2013 all the way to 2024. So more than 10 years of financial data, which is the ideal situation. Gives you a full decade picture of how they've performed in that past decade. And so anything even beyond that is that much better, but I like to kind of cap it at 2013 and then move on from there and continue to add rows or add columns as the time progresses. So we can see here though, again, looking at Travelers revenue, 26 billion in 2013. In 2019, they were at 32 billion. And as of 2024, they're at 46 billion. So trending in the right direction. If you look at the growth metrics here, it's not as fast growing as PDD or Uber, but it is growing consistently. And you are seeing that throughout the board from a sales standpoint. You will notice that as well when you're looking at the profitability, book value, free cash flow. All of them are trending in the same direction. Not as high of a clip because it's a much more established business. It's more mature. It's in a different market than technology, but it is that consistency and predictability that Warren Buffett always raves about. And I think it is a good way to protect yourself and make sure that you're making smart investments. So, we talked a little bit about net profit there, 4% growth rate over a 9-year period. You're going to see that here. So again, 3.6 billion of profit in 2013. 2019, they were at 2.6 billion, so it actually fell, but as of the last year, they were at $5 billion of profit. Great sign. You're seeing their profit margin consistently be about 8 to 10%, so definitely a decent sign. And on a 5-year basis, over the past 5 years, they're at 9% profit margin. Definitely a decent position. Ideally, it could be higher, but again, you have to factor in the industry they operate in and where they are within that market. And so I think this is a good sign overall. Still a healthy business nonetheless. Just obviously, the higher the profit margin, the better and more powerful, let's say, the company is. So moving on to book value here, we're seeing in 2013, 25 billion. As of 2019, they're at 26 billion, and this is at 28 billion as of 2024. So slower growth, you're seeing that here, only about 2% growth annually over the past 9 years. So that's obviously being reflected as well. Slower growth, but definitely positive, and they have billions and billions of dollars in regards to book value. Great sign overall. Lastly, first we'll look at debt. 6 billion here. This has kind of stayed consistent, and in recent years they have grown a bit to 8 billion, but on a debt to free cash flow yield, it is at 88%, so below 100%, which means that they could essentially pay off all their long-term debt with 1 year's worth of free cash flow. And you will see that in 2013, they had about $3.7 billion in free cash flow. 2019, they got $5 billion in free cash flow. And as of 2024, $9 billion in free cash flow. This is actually growing at the fastest clip of everything when it comes to revenue, net income, book value. And it's growing at 12%. It is double any of the other metrics. This is the best sign. Really, of all the things that could stand out in this company is that their free cash flow is growing faster than any of these other metrics. All the other ones are important, but none is as important as the cash that you can retain on an annual basis. And this is where it really stands out. Something that I think is a very big positive for the Travelers Company, and they've clearly demonstrated that they can do it consistently and grow at a good clip over the long run. So lastly here, you can see return on invested capital over a 5-year basis is at 10%, another strong reflection of a healthy business overall, and something that is just a positive in general for the company there. Now, in terms of valuation, we are looking at a value of $72 billion. So that is what we think the company is worth. And compared to a market cap of $65.6 billion, it is essentially pretty much fair value, just slightly undervalued if you wanted to say, which is a decent position. You know, you look at this company again, you see these consistent financials, healthy position, and you see that it's trading at a reasonable price. This is something that you would definitely want to consider and factor into your investment list because it is just a solid, healthy company. You're seeing that consistency, that predictability, which is a very important part. It gives you a lot of ease of mind when you're investing. And it is one of those things that you can confidently know and have a good idea of what they're going to do in the next year if they continue to grow at this current clip. So another solid business based on this initial rank. This is where I put it. And this is just looking directly at these sheets. I would say Pinduoduo, number 1, Travelers Company, number 2, and Uber, number 3 as of right now. Now, that said, the financials are only one part of it. It is a very important part. I argue that it is probably the most important part because it truly is a reflection. The numbers do not lie, but there is so much more to trying to understand companies and deciding whether you want to add it to your portfolio. You want to study their management team. You want to study their share breakdown, how many, what products they sell, what markets they operate in. So many different elements. Ultimately, it's a continual process. You need to learn about these companies. You want to stay on top of them, and you want to be able to find businesses that, again, you can have a lot of confidence that they're delivering high quality products that customers love and are going to continue to buy. That is the ultimate goal. Now, to do that, there's a couple different ways. First, I want to introduce you to a website that I've always been a big fan of. I think it's a great tool. Now, from a free element, you're capped at looking at 5 companies in a month, I think. So that kind of sucks. Maybe it's a week, but that's not ideal from those who are looking for free tools, but it is still a very good business. And it is something that I'm a big fan of because why do I like Simply Wall Street? Well, it looks at businesses in a very similar way that I do overall. It is going to value businesses. It is going to tell you their valuation. It is going to look at different elements of their financial standpoint. It is going to look at management's ownership breakdown, how much they own the business. This is a really good website overall, and I'm a big fan. Just wish that their free version was a little more accessible, but if you're willing to pay and you want to make the most of it, this is one of the most highly recommended platforms. And, I have no affiliation with them. Again, if they want to sponsor me, that would be fantastic. But really, I'm just going to use it as we go here and just give you a good perspective. So one thing that they use is a snowflake chart here. You can see that they break it down by the health of the company. So that's really the quality I think that you could look at. They got a measurement for dividends. I don't really care about, so who cares if that's low. Value. That's the value part. So quality and value, those are the 2 most important things that I care about. And as you can see, both of them reach the outer edges. They hit all the check marks. Future, less certain, a lot more questions. And past, only been around for 8 years in terms of financial statements, so it's less clear. So as I've kind of talked about, this is a good website. It mimics kind of the philosophy that I approach, and I highly recommend it. Couple of highlights here. They believe that it's trading at 70% below their estimate of fair value. So they think it's 70% undervalued, similar to what I said. Earnings are forecasted to grow at 12%. Well, that's pretty solid again. We capped our total growth for free cash flow at 25%. So this is even more conservative from that element. And it is looking at earnings, not free cash flow, but it's kind of generally what their growth rate expectations are. And then they measure it against peers and then based on what analysts think. So, we'll just go through this quick, but you can see that they've got a breakdown of competitors or potential others. So you see Alibaba here. C, I'm not too sure about. Mercado Libre's another retailer, I believe, e-commerce company, and then Coupang, not too sure about, but you can kind of assess and see where they're at. And then relative to those peers or more, this is a discovery tool to find other businesses. You can see their long-term historical financial performance. So at least on a yearly basis, you can zoom that out to, as long as you want here. But again, I don't necessarily care about the price too much. What I care about is where it is in relation to value. So I don't look at stock prices too much. I just wait until the opportunities come about. You can see price volatility though. So that's beta. Gotta love it. Can't stand it. Just watch the last video. You'll see what I mean. And see their PE ratio as of today is only 10.3. So another indication that they're probably undervalued for an e-commerce company. A lot of these tech companies are trading at 30 PE, so 10.3. Just another reinforcement of that. Then they have a waterfall that provides a breakdown of their cost of revenue, and then their gross profit, their other expenses, and then the profit that they ultimately make here. It provides a net profit margin of 24% here, solid gross margin of 57%. That's another solid sign. Debt to equity of 1.3%. So they do capture some level of debt, but again, it's 1.3%. It's essentially virtually zero, let's say. So then they got valuation here. This is where they provide a breakdown. So they think on a per share basis that the company is worth about $347 per share, and it's currently trading at 106. So there's that valuation. Again, seems to be undervalued. I keep looking down, you'll see more here, and I'm just going to skip because we've kind of gone over these things, but lots of good information. This is what I want to talk about because this is another of the most valuable pieces that I think is associated with this company here is the management side of things. You can look at who their manager is, how long they have operated for, and ideally, again, you want somebody first who has been in the business or the game for a long time, who knows the company well. Second, you want to hope that they're the founder. If they're the founder of the company, the business is like their little baby. They want to see that thing grow. They want to see it thrive. So they are going to do whatever it takes to build a long-term sustainable business. And lastly is their ownership structure. And depending on the company, especially because this is a Chinese company, this data may not always be available. And in this case, you're not seeing their ownership breakdown, how much of the business they own. But ideally, you want to see that they own a good portion of it. A lot of management you'll see own around roughly 1% of the business. But some of these founder CEOs can own upwards of 40% of a company. So if you see that and it is higher, as an investor that any company you are investing in where the management owns a high percentage of the business, that they are in it and aligned with you because their money, their net worth, their future, their wealth, all that is tied to the same success of the business. And so you can invest in it. You're going to believe that they're going to do really well and put the company in the best position overall because they have a lot of stake. They don't want to mess up. They want to make as much money and retire well and pass it on to generations and all that. And so that's what you want to look out for from a management standpoint. So just a quick rundown on Simply Wall Street of Pinduoduo. They don't have any ownership or management information here, but that's something that I'm always a big fan of is 6 and 7 here, as well as valuation for comparing against what I assess. So we will now apply that to the other companies here. So look at Uber. So you are going to see a differentiation in opinion, and this is a differentiation in approach. And again, it's not saying that my approach is best. It's not saying that Simply Wall Street's approach is best. What you want to do is as much perspective as you can get and different ideas about what you think these companies, the quality of these companies are, as well as what they're worth. It's just going to enhance your view of it overall. And this is a good point to look at. They think that it's worth trading 52% below its estimate of fair value. So they're assessing that it's about 50% undervalued. I thought the company is worth about $24 billion versus my valuation, and it's trading at about $156 billion. So I think that it right now is significantly overvalued. One thing to consider and something to look at, where you can see this growth rate, and they're looking at different factors. They're probably factoring in like on a quarterly basis where financials are at. They're taking in analyst perspectives of future outlooks on growth as well. So that's how they assess it. But you can see here from the snowflake, health, Health, a little less than Pinduoduo's, one bar less, one less check. Value, checks all the boxes. They think it's significantly undervalued. They think the past is decent and their future less certain, no dividend. So it looks overall like a decent spot. It's checking the bars that generally I highlight. Of course, this is their approach. And we're actually going to skip the financials because we've kind of looked at that here, but we'll go to management because we want to see where their ownership structure is at and how much they are currently managing and holding. You can also see how long the CEO, so the tenure of Dara Khosrowshahi, sorry, I definitely botched that name, 8.3 years as CEO. Now, CEO ownership, you can see, is only 0.05%. This Dara person has done a good job of growing the business and achieving profitability in the past couple of years, so commend them for that. They're definitely doing well as CEO for the most part. The only point of criticism is that I would question, why is their ownership so low? So you can see that this is quite consistent with all their leading managers, less than 1% for all of them. It's still a decent chunk of money, all in the millions, and Dara has $78 million of essentially shares that she owns, or he. But it's one of those things that, again, the more the merrier. So you can look at the board too, because sometimes you can see the founders' data. Garrett Camp here says no data, so tough to know exactly how much ownership, at least from here, but you can usually find that information online as well. Search it out. Again, not a bad thing. They all have ownership in the business, but ideally that is a lot more. And if you see that thing at 30%, any of these individuals owning 30% of the business, they are super invested in the company's success. So another good look, good perspective with Uber providing different information and showing that, my valuation method might not be right. And maybe you want to look at theirs as well. So something to question and then be able to look in at different angles. Last but not least, we'll look at Travelers here. So we'll see here that they have a much more critical view overall of Travelers, and they are seeing that the financial health is not as strong. Their value is less attractive. Their future, absolutely nothing. And their past is underwhelming. So this is a much more critical assessment. Is this the right company? So there you go. Prime example, look at the right company, because we are seeing a very different picture now that we are looking at the Travelers companies. I was kind of questioning why all the fundamentals in their assessment was so critical relative to mine. It didn't make sense. It didn't align. This is more realistic. So their health, it's a bit poorer than Uber's or Pinduoduo's, but still decent, in the green. This company actually has a dividend, so if you like dividends, something definitely to consider. Value, pretty attractive, and they're showing that it's 52% undervalued. Earnings growth of 29% over the past year, so solid, pays a reliable dividend of 1.5%. Decent information here, and they have a strong past. That's what I was talking about, more than 10 years of consistent growth. That's what you like to see. So we'll go to valuation here, see what they believe the company is trading at per share, and then we will jump to management and check out the last element here. So they're thinking that the company is worth essentially $619 per share, and it's currently trading at $294 per share, so 52% undervalued. Attractive price kind of reflects what I was saying. I actually believe that it is less undervalued, so a bit more conservative of an assessment. But again, if it is 52%, hell yeah, that's a pretty solid sign overall. So then we will jump to management, and we'll see that the CEO tenure has been 10 years. Small ownership again, not ideal, but 10 years, been in the game for a while, understands the industry, understands the business. That's a good sign. And then you can see here the amount of ownership that they own. So similar to Dara at Uber, about $80 million in shares that they own, essentially. And you're seeing that they all have ownership. It's just, again, the more the merrier that they own, because the more aligned that they'll be. And we'll see here if there's any directors here. Check and see if any of them have high ownership, and it doesn't look like there's any data on the independent directors. So, decent overall. Again, would love to see more, but there are a lot of companies out there with way higher ownership, and that is truly one of the most important factors as well. I think it really does show alignment. It's not the biggest thing in the sense that you can still fare well with a CEO who isn't a founder or who doesn't have ownership. They could be a very talented individual, but it is always bonus points if you can find that founder, and especially if they own a lot of the business themselves. So one thing to consider. And now I'm realizing that we are almost coming up on an hour, and so I'm actually going to save the next element probably for the next video, and we'll do a further deep dive. But good introduction to Simply Wall Street. We've looked at the financials of Travelers, or the Travelers Company, Uber, and Pinduoduo. And the last thing we want to see is the top 10 stocks now that we have added these businesses to the list and updated the valuation or relative valuations of all the companies in the list here. And so without further ado, the top 10 companies as of the week of December 19th are: at number 1, Euroseas; at number 2, Copart; at number 3, Fortinet; at number 4, Medifast; at number 5, Nvidia; at number 6, Regeneron Pharmaceuticals; at number 7, Arista Networks; at number 8, PDD Holdings. So it has joined the top 10 list. At number 9, Adobe; and at number 10, Primerica. So overall stayed the same, but we have a new entrant on that top 10 list. Something very exciting always when you find a very, very high quality company. And in the next video, we will do even further deep dive so you can learn that much more about these businesses. But so far, a pretty productive episode. Definitely rambled on here and there, some more things to improve upon, but we will continue to work at it, and looking forward for all of you to go and watch it. And if you have gotten this far, thanks a ton for watching it.